I'm going to take just a couple minutes and share with you a method for wealth accumulation that most people are not accustomed to or not aware of. Now, high net worth individuals, high income individuals, they've been using this method for years and years and years. But for many of Americans, probably the vast majority of Americans, this has been an unknown system to them. So let me walk you through this. So this is loaning your way to wealth, loaning your way to wealth. As you're aware, the privatized banking system allows you to set up multiple accounts. You should have a system of between 6 and 12 of these accounts. Those accounts can then be used for specialties, for different items, right? So these are the accounts that we're referencing, and you should review previous videos, but these are properly structured, dividend-paying, whole life insurance policies, okay? They're built for banking. There's only 7 companies in the United States that do it. Most companies do not do or offer this kind of product. Most whole life products that you've seen out there do not function for banking. They're not very good for the cash growth, and they're not very good for the cost of insurance. They're expensive and they don't grow very quickly. I'm not talking about those. I'm talking about products that have been designed for our industry. They've been designed for privatized banking. So those accounts then have the capacity. You stack them up or capitalize them. Don't be afraid to capitalize them. One of the things that Nelson Nash, my mentor and the founder of the Infinite Banking Concept, always taught, don't be afraid to capitalize these accounts. So build these accounts up as much and high as you can, as quickly as you can. Then, okay, we're going to talk about loaning your way to wealth. So number one, you need to reduce your expenses. So look at your cash flow, all the income that you have and all the outgo that you have. And you know, when we sit down with a new client, or we sit down to train a new advisor, we draw a box on a piece of paper, and inside of that box we put personal economy, 2 words, right? And for personal economy, we have one side, which is all the money coming in their personal economy. The other side is all the money going out of their personal economy. Most financial advisors focus on the left-hand side of the personal economy, which is just how much money you've got coming in. They want to get 10 or 15% of the money that you're currently making. They want you to give it to them so that they can invest it in some type of interest-bearing vehicle and hopefully provide you for the retirement that you want in the future. They never pay any attention to the right-hand side of the equation, which deals with not just 10 or 15% of your income, but 100% of your income. And it's not dealing with maybe a 10% rate of return or something of that nature. It's dealing with on average, a 25% cost from either paying cash or financing. So this massive figure, right? So you have to find a way to eliminate or reduce your expenses. We'll work with you on that. You need a budget that's written, specific, workable, pliable, so you can update it as time passes. Wellington also will provide you with a P&L or a profit loss statement, even for your household. You say, Scott, I'm not a business owner. You don't have to be. You should have a P&L for your household. Okay, and then a net worth statement is the third tool that we use to allow you to determine exactly where your money is going. We help you check your net worth every quarter. So every 3 months, we're going to take a snapshot and look to see how you're trending. How are you doing with your net worth? Bottom line is, if you partner with Wellington, this is my guarantee, straight from Scott Crutchfield himself. My guarantee to you is no one will outwork us to earn your business and to multiply your wealth and to help you achieve your financial objectives in life. No one will do that, okay? You have my personal guarantee. So first thing you do is you reduce your expenses, make your personal economy more efficient, okay? The second thing you do is you determine where is a good savings warehouse, right? All wealth must live somewhere. Nelson used to give this analogy. If you think about water on the planet, about 75% of the Earth's surface is covered by water. Of that 75% covered by water, there's all kinds of oceans and lakes and streams and rivers and reservoirs, all these different things. But all the water on the planet's really connected. If the Atlantic Ocean were to suddenly rise by 2 feet, it would affect the Pacific and the Indian Ocean, all the different bodies of water, the Black Sea, all the different bodies of water across the planet, because they're all really interconnected. So water, right, will fall in one of 4 forms, right, from the clouds, and it'll find a stream that finds a river, that finds an ocean, and then the sunlight will evaporate a portion of that, and it starts the cycle all over again, right? So it's constantly flowing. You've got to understand in your mind, flow, okay? Water must flow. And part of it's got to flow through me and you at least every 3 days or we die, right? So some of that water is flowing through us. Blood must flow. If the blood stops circulating your body, then you are no more, right? Your time is up. You're punched out of here. And the third thing is money must flow. So we want you to understand the flow of money. Okay, so when it comes to a savings warehouse, knowing all money must live somewhere, what do you need? What kind of warehouse should you look for? Well, it should be protected from taxes, right? Privatized banking accounts are privatized systems using the properly structured dividend-paying whole life insurance policy are protected from taxes. They're also protected from creditors. So if creditors try to attach your personal assets because of some debt, whether it's right or whether it's wrong, they're protected inside of these accounts. Thirdly, you have a guaranteed floor of either 3 or 4% on these accounts. A guaranteed floor, which means it can never go below that, right? So you're always going to get that the rest of your life. In fact, me or one of our qualified advisors can predict for you 30, 40, 50 years in the future, exactly to the penny what you'll have in your account. Now, that's because it's guaranteed, right? Now, what's not guaranteed is the dividends above that. Those are very predictable, but they're not guaranteed. So they're above that. Those are not guaranteed form of income, but they're over and above that. So we can predict 30, 40, 50 years in the future what the floor is, right? So we know the worst case scenario, and then the dividends, of course, add to that. If you look at all that together, you should be seeing a growth rate of 4, 5, 6%, something like that, before taxes. Okay. Now, if you have people telling you, well, I can get 10%, 12%, that's not true. Y'all, these are dividend-paying whole life insurance policies. They're ultra conservative, and they're built to be that. They're guaranteed. The life insurance death benefit's guaranteed. The premium is guaranteed. And then the cash value accumulation is guaranteed. All three of those aspects of this contract are guaranteed, okay? So you have a good savings warehouse. So you start by reducing what you're spending. Make sense? Make things more tight, more efficient. Number two, you find a savings warehouse, one of these good dividend-paying whole life insurance policies to put your cash in. And then number three, you engage in lending. Now, you say lending, Scott, I didn't know that was part of the plan. Well, what lending does is it allows you to leverage the cash value that you have in your account to earn an even greater return on your money. Okay, because you have a fixed cost of funds, COF. Your cost of funds is somewhere around 4 or 5%. Okay, it's always going to be somewhere close to 4 or 5%. So we know this, right? This is our bogey. That's what we have to hit. So anything I get above 4 or 5% is an increase. Let me give you one example. Let's say that my cost of funds is 4%. And then let's say that I'm able to go out here and get a bridge loan for 8%. Let's say I can earn 8% on my money. Well, 4% to 8% is not a 4% return. Listen to me, this is so important. It's 100% return because you've just taken 4% and you've doubled it. So actually you've got 100% rate of return on your money. So know cash flow, your cost of funds. Secondly, know the bridge loans. There are all types of these that Wellington will connect you with. Speak with me and myself or one of our advisors. We'll help you get connected with these accounts. They're all backed by real estate, all kinds of information we can get you on these, but they will yield 8 to 10%. And then expand your banking capacity, because as this starts to grow, you're going to want a bigger bucket, right? You know, in Jaws, you know, one of the famous line in Jaws is, we're going to need a bigger boat, right? You're going to need a bigger bucket. You're going to need a bigger place to put these funds in. So here's what the process looks like. I'll tell you this and we're done. Reduce what you're spending right now. Save. Build up that savings capacity and then lend. Reduce, save, lend, reduce, save, lend, reduce, save, lend. That'll be the rhythm that you take on in this. And so capitalize the account. You've got to shove assets into these accounts. Once you've done that, then you've got the ability to expand and to grow even further. This is how you loan your way to wealth.